So something I'd like to just walk through now that often puts me off when it comes to putting up my Bitcoin as collateral. The first major thing for me is counterparty risk. And I think you've already described very, very well how you've significantly reduced the existing or the status quo counterparty risk that existed before. It's like this is much, much better as a product than a Celsius or a BlockFi, etc. And that's cool. The next part of it then is the liquidation risk. So with a short-term volatility like Bitcoin, it's all over the shop. And one of the things that I think concerns me with taking debt on your Bitcoin is the idea of getting margin called and just not concentrating properly. And you get an email, it's absolutely correct, you signed up to it all, but before you know it, a quarter of your position's gone. And you're like, oh, well, that wasn't quite what I was planning. So is there any way to help a user in that sense to not get margin called? And, is there a way to give people as much forewarning as possible?
Yeah, listen, I mean, in terms of liquidation, obviously, I would say this is the biggest risk as always, right? We know that Bitcoin can be pretty volatile at times, even though I believe that after what's been happening in the last couple of months and years, the volatility is continuously decreasing. And I believe and I hope that we won't see like one day 50% spikes as we did in the past. At the same time, definitely, we always advise the borrowers first and foremost never to lock all their stack that they have available, right? So if I have one Bitcoin, I wouldn't ever like just lock it as it is and get the full or get the loan against my full stack, right? So we always advise to have additional Bitcoin available exactly for the times of higher volatility, right? So the borrowers have the option to top up their collateral at any point in time. As I mentioned, the LTV is 50%. So it's kind of Bitcoin would need to move around 50% to the downside to get liquidated. But to be prepared for that, it's a very good practice, first and foremost, to lock more collateral. So to decrease your loan to value to even lower levels. Like I would actually say, like looking at the stats, the average loan to value is around 40. So people do not even stick to 50, but they always kind of add more collateral, so they are actually decreasing the liquidation price that is obviously available for them from the very first moment. So once you lock your Bitcoin, you see the level of LTV 95%. So that's our liquidation level, where you would get liquidated at any point in time. As I mentioned, you have the opportunity to top up the collateral. Secondly, to your point, yes, obviously there's a number of margin calls, but as we know, the worst market shift happen overnight when everybody's sleeping. So you don't want to get into such situations. So I would say really the good practice is to kind of make sure that your LTV is low enough, that you top up your collateral if you feel like, you're going for holidays or, there's been some market movements and all that. And last but not least, one thing that we want to, because we also have to consider that we need to protect the investors, right? So the lenders. So there has to be a liquidation level. There has to be a process that automatically liquidates your collateral in case of massive market shift and the value not being enough to cover for the investment from the lender. At the same time, we are actually building something that I would call a liquidation protection tool, meaning you could actually opt in for a scheme or for a, let's say, product or service that would help you to protect your collateral from ever being liquidated, right? So there are different ways of doing it. There's obviously additional potential risks, like counterparty risks and all that might be involved. But for many people, this would be a good option. Like, hey, I'm going for holidays, I want to protect my collateral for at least two weeks, right? So you would get a window, like for a 2 weeks window, where your collateral wouldn't get liquidated and you would have a chance to top up the collateral. So that's something we're building. We already have the white paper or the kind of details of the service on a paper, actually, I would say. Obviously, the priorities have been somewhere else, in terms of getting the traction and kind of launching new currencies and all that. But this is definitely something that I feel that a lot of borrowers would really appreciate, as well as investors, because I would say sometimes the initial or the very first question from any investor, any lender is like, okay, so what happens if the counterparty doesn't repay? Or what happens if Bitcoin falls 70%, right? That's naturally your first question. So I think this kind of approach would bring a lot of benefits to both parties.
Yeah, that's really cool. And immediately it's another product line. So potentially additional
Absolutely.
revenues for you guys, which is awesome.
Absolutely.
I think if I sat here now and thought this through, um, I would have Bitcoin available for something like this, and I'd think of it as a portfolio allocation of like, okay, this percentage of my portfolio I'm going to put up and take some leverage against, and I'm going to have a reserve amount of Bitcoin over here in case the market's very volatile to the downside. Obviously, the benefit of Bitcoin is it might be volatile to the upside, so you might actually be able to change those allocations, which is cool.